Welcome back to the channel. Today we're breaking down a retirement investor's dream matchup, DGRO versus SCHD, two of the most popular dividend ETFs in America. But here's the twist. We're not doing the usual shallow which ETF is better review. No, today, we're going to look at the real math, the real dividend engines, and the real long-term retirement outcome. By the end of this video, you'll know exactly which ETF can help you retire richer, DGRO or SCHD. This video is for educational purposes only and not financial advice. Always do your own research or consult a licensed financial professional before making investment decisions. Hello viewers, if you are enjoying this content, and you do not want to miss future videos filled with even more tips, tricks, and inspiration, hit that subscribe button now to stay tuned with us and remember to comment and share. Both ETFs serve different investment strategies, catering to varied financial goals. While DGRO focuses on the sustainability and growth of dividends over time, SCHD provides a more immediate income stream through higher yields. This distinction is crucial for investors identifying their priorities. DGRO nurtures long-term wealth accumulation, whereas SCHD emphasizes current cash flow, making each a valuable tool depending on one's financial needs. By understanding these core differences, investors can tailor their portfolios effectively. DGRO nurtures stability for long-term investors. In conclusion, both DGRO and SCHD offer unique benefits within the dividend-paying space, serving distinct investor preferences and strategies. By recognizing their individual characteristics, investors can optimize their approaches and achieve their desired financial outcomes, paving the way for successful investment journeys. DGRO and SCHD each offer unique investment philosophies. DGRO emphasizes long-term growth in dividend income, requiring companies to consistently increase dividends. In contrast, SCHD targets high-quality yield with immediate rewards, focusing on financial strength and robust returns. Investors choosing between these two must consider their priorities, consistency and growth or immediate income and quality. DGRO investors may appreciate the gradual increase in their income stream, especially as companies continue to enhance their dividends over time. Both strategies appeal to different investors, yet they share the common goal of generating reliable income through dividends, showcasing the importance of aligning investment choices with individual financial needs and growth aspirations. Ultimately, understanding these philosophies empowers investors to make informed decisions about their portfolios. In the DGRO methodology, companies lacking consistent dividend growth are systematically excluded, ensuring only reliable dividend payers remain within the index. This approach fosters a stable investment environment. The SCHD methodology encompasses a thorough screening process. By utilizing rigorous financial metrics, SCHD effectively ranks over 2,500 stocks, focusing on return on equity, dividend growth, cash flow to debt, and yield, while strategically limiting sector exposure to mitigate risks and enhance portfolio diversification in the ever-evolving market landscape. SCHD is far more selective. DGRO is more diversified. This difference shows up in returns. DGRO focuses heavily on technology and financial sectors. SCHD emphasizes industrials and staples. In conclusion, both DGRO and SCHD showcase distinct sector approaches, reflecting their investment philosophies and strategies, with DGRO leaning towards technology's growth potential, while SCHD embraces stability through industrials and consumer staples. DGRO is more growth tilted because of tech. SCHD is more value tilted because of quality screens. DGRO appeals to those seeking emerging opportunities in dividend growth, aiming to capture younger, dynamic companies that can sustain an 8 to 12% growth rate annually. In contrast, SCHD embodies stability, representing established firms that deliver robust 12 to 15% dividend growth. DGRO focuses on younger companies, which may offer higher potential upside, while SCHD relies on tried and true businesses that showcase consistent and reliable cash flows. Both DGRO and SCHD cater to different dividend investors, DGRO for growth and potential in younger firms, and SCHD for stability and reliability in mature companies, thus offering unique advantages for diverse investment strategies. DGRO may present a lower yield compared to SCHD, but its strength shines during tech rallies when growth stocks thrive and offer significant returns. In contrast, SCHD excels in value cycles, effectively catering to income-focused investors. In the ever-evolving landscape of investments, understanding these dynamics enables investors to strategically align their portfolios based on market conditions. Whether prioritizing growth or income, choosing between DGRO and SCHD can lead to advantages tailored to personal financial goals. Let's imagine you invested $10,000 10 years ago into each ETF. You're looking at DGRO stronger capital gains during tech booms, SCHD strong income and impressive total returns in quality-led markets. Historically, SCHD has slightly outperformed DGRO in total return, but not every year. Tech-heavy years equals DGRO wins, income-heavy years equals SCHD wins. DGRO offers a balanced approach, appealing to those who prioritize diversification and lower volatility. In contrast, SCHD attracts investors seeking resilient fundamentals and a bit more economic heft. Retirement investors typically favor SCHD. While DGRO provides a safer, broader investment opportunity, SCHD stands out for its stability and robust fundamentals, making it a favored choice among retirement investors seeking reliable growth in their portfolios. In today's financial landscape, retirees face varying needs for income and growth. For those prioritizing immediate income, SCHD stands out as a robust choice. Conversely, for individuals who can tolerate some initial sacrifice for potential future gain, DGRO presents an attractive option, promising stability and diversification along with solid growth potential. If you seek reliability in your investments, DGRO's diversified strategy offers a secure framework for managing risks. Choosing between SCHD and DGRO ultimately depends on your individual retirement goals, whether they lean towards immediate income, growth potential, or long-term stability, ensuring a clear path towards financial security in retirement. After 8 minutes of analysis, simulations, index research, and breakdowns, here's the truth, black exclamation mark emoji, there is no universal winner. There is a winner for your retirement strategy. Choose SCHD if you want higher reliable income, you want quality screens protecting you, you're closer to retirement, you want a simpler, more defensive ETF. Choose DGRO if you want more exposure to growth sectors, you plan for 20 to 30 years of compounding, you prioritize dividend growth over yield, you want broader diversification. The blended winner, 50% SCHD plus 50% DGRO. This gives high quality, strong growth, great income, less volatility, better long-term balance. Thanks for watching today's deep dive. If you found value in this breakdown, make sure to like, subscribe, and comment. DGRO or SCHD, which one are you choosing? See you in the next video.